Good morning and welcome to your Monday, 11th of March market news update. The US economy added more jobs than expected, yet last month's blowout result was revised sharply lower. Nvidia dropped by 10% on Friday as traders see the end of the ride nearing. Gold hit a fresh record high of $2,200 on Friday as demand for the safe haven asset skyrocketed last week. Chinese economy exited deflationary territory in February and provided support for the yuan. The Japanese economy narrowly avoided a recession in Q4 and blasted bets for rate hikes by BOJ. Equity traders braced for Oracle's earnings results in the US after market hours. Finally, sterling gained substantial strength against the dollar last week and hit 7-month highs. That's all for now, and stay tuned for tomorrow's market update.
Hi everybody and welcome to another daily presentation. This is the market overview for the 11th of March of 2024, and these are the key events that you should familiarize yourself before starting your own trading day. Well, the first topic of conversation is going to be about the latest NFP print. So the greenback extended its fall last Friday and finished the week deep in the reds, and from a week-to-week kind of point of view, we saw it shedding more than 1%, as we saw the February's employment data, albeit coming in better than expected. The prior month's results underwent sharp downward revisions. Now, furthermore, we saw the unemployment rate upticking, and at the same time, wage growth slowing more than anticipated, which created distortion in the market. Yet, at the end of the day, calls for a 25 basis point rate cut by the Federal Reserve in the month of June are, or is much more appropriately, the prominent scenario for the time being. So no major alterations in regards to the projections of the market for the Federal Reserve's monetary policy plans going forward. So equity markets, more specifically, opened the session in the greens on Friday, but after Nvidia and other mega cap stocks plunged in the reds, we saw the averages, all the other indices following suit in the reds, closing the session again in the reds near all-time high territory. Okay, so gold, on the other hand, rallied deeper into uncharted all-time high territory, hit a fresh record high near the $2,200 as the devaluation of the dollar, the fall of bond yields, and the absence of bears allows this precious commodity to scale to new heights. Now, nevertheless, investors are currently holding their horses, if you like, and standing by, bracing for tomorrow's inflation update from the United States before taking any big bets. So the data will ultimately influence the Federal Reserve's monetary policy decisions going forward, and could shed light on whether the central bank will pivot to easing in June or whether we're going to get some sort of hot CPI print, which is going to push back the market to loosen up, if you will, like these aggressive calls for rate cuts in 2024. For the time being, we will be bracing for tomorrow's CPI print from the United States, which is obviously the main event of this week. Now, beyond the NFP print, let's move on to the next topic of conversation, which is going to be about China, who posted their results on Saturday, showcasing that the data at least showcases that they have escaped deflation territory. So the CPI data released over the weekend showcased that price pressures in China rebounded from negative territory and rose to the 0.7% level in the month of February and pulled, in a sense, the red giant out of a 5-month-long deflation loop and ultimately eased investors' tensions, at least partly. Okay, given the positive development, calls that foresaw the PBOC slashing its policy rates further, loan prime rate, for example, to spare up economic activity and supercharge the country's stalling recovery process, this is definitely a fact, lost momentum in money markets and clouded economists' outlook for this further rate cut or easing measures by PBOC, given that we see inflationary pressures rebounding from negative territory. Now, the yuan has indeed strengthened against the dollar, nothing major, however, and since today's market open and is currently moving towards a 1-month high. And on the contrary, Chinese stock markets extended the winning streaks and hit 3-month highs. Okay, so the recently deployed stimulus measures by Beijing officials more specifically, and the slashing of the PBOC's rates appear to do the trick for the time being. And we see perceptions of investors towards the Chinese economy seem to be improving given this kind of data. We saw also robust trading activity improving in the month of February, as we saw the results of exports and imports growth, respectively, from the Chinese economy in the month of February last week. Another positive development. We also heard from the from the NPC conference, Chinese authorities feeling the need to support the economy. They have kept the growth rate projection unchanged from last year. So 5% is expected from China. Some people say they will not be able to achieve this. We will see whether that will be the case. So the Chinese authorities are indeed aware of their issues. They are actually targeting them with the relevant measures in order to fix the situation and bring back the Chinese economy back to the pole position, if you will like, or at least challenge the dominancy of the United States economy. So overall, we see these kind of measures creating this positive sentiment and environment for investors, which we will see whether they're going to allocate funds towards the Chinese economy, believing in a sense that they will rebound back into these kind of the good old days in a sense, and expand at this kind of rapid pace. Okay, so yesterday Sunday, we also see the central bank PBOC also announcing that it will aid further the nation's capital markets, announcing that it would put in place a so-called Stocks Connect support programs, but also help to optimize the investment environment that could attract and facilitate flows towards the country's financial markets. So we see day after day, week after week, the Chinese officials, not only from Beijing, but also from the central bank, being aware of the issues, but also at the same time deploying measures to fix them. So this creates this underlying kind of catalyst environment that would, in theory, allow the Chinese economy to finish up with its recovery progress and get back to its feet, and from there on, possibly sprint. We'll see. Okay, for the time being, this has been the end of today's session, guys. Thanks for watching, and we'll catch you on to tomorrow's session for another brief update. Take care. Bye-bye.
In this video, we will look at news trading on economic releases. This trading strategy is appealing to many short-term Forex traders. As markets move in response to news, the release of economic data is frequently the most important catalyst for short-term movements. Essentially, this trading strategy involves trading around significant Forex news events, such as key economic releases from the countries whose national currencies consist of the major currency pairs. Because key news releases have a strong influence on currency pricing, a Forex trader can use them to potentially profit from those movements. There are 8 major currencies available for trading, so there is always some economic data available that Forex traders can use to make informed trades. Dozens of economic data are released almost each weekday, excluding holidays, from the 8 major most followed countries. As a result, there are numerous opportunities for traders who prefer to trade news. As the US dollar is on the other side of 90% of all currency trades, US economic releases tend to have the most noticeable impact on Forex markets. If you want to trade news successfully in the Forex market, you must know when reports are expected and which releases are most significant given the current economic conditions. Generally, the most important information relates to changes in interest rates, inflation, and economic growth, retail sales, manufacturing, and industrial production. To sum up, it's important to do your research and stay current on economic news in order to reap the benefits. Thank you for watching.
So today we're gonna continue from where we left off last time. We're still on the topic of fundamental analysis, more specifically because fundamental analysis is a super broad category and can be applied on many different stuff. We are primarily concerned with economic indicators more specifically. So these are the stuff that affect how economies behave, or at least how they shape, okay, how traders see those economies performing. Okay, so today's topic is going to be part 2. Last webinar we went over 2 main categories of economic indicators, namely growth, and the other one was inflation. This webinar we're going to go over consumption and employment. Those are the broadest kind of categories, and we're gonna speak about those indicators that fall under these kind of categories. Okay, analyze them. Okay, firstly identify them, present them to you to just keep an eye out. What are the main indicators that drive markets or drive current underlying prices of those countries' currencies? Okay, then we're gonna interpret them and then break them down, say what are they actually communicating to us as information wise, and lastly how you can, in a sense, decode them given the actual values that they actually give us. Okay, so without further ado, let's get started. This is a quick risk warning and a disclaimer. I'm not going to go over it. You can read this at your own time. So let's go ahead. Let me put my phone on silent because it's just buzzing. Okay, so what we will go over in this kind of session, this is the agenda overview of economic indicators. We've done this on the past webinar. We're going to do a small recap, the broad categories of economic indicators. Once again, going to be a recap, and we're going to delve into economic indicators, which are going to be for the categories of employment and consumption. Lastly, understand how these kind of releases affect the FX market primarily. Okay, so I'm not going to find information here that's going to drive directly, this is the key point, the prices of, for example, a precious metal, the gold, or the prices of crude. They can affect them indirectly, not directly, but still, we're primarily concerned with currency pairs here, so FX rates, how they are actually affecting those. So what are economic indicators? Let's do the small recap. So the definition, in a sense, of economic indicators is they are statistics, okay? So they are quantifiable values. So there are statistics about economic activity. Since the nature of economic indicators is numerically based, fundamental analysts use this data that indicators provide to, in a sense, analyze it, quantify it, and make kind of predictions about the future performance of any given country's kind of release. Okay, so essentially they provide a snapshot of the specific economic activity within a market, and there is plenty of economic activity or branches of economic activity within a country. So, and piecing all these kind of indicators together and the information they convey, we can create, in a sense, a holistic kind of view of how an economy is behaving, and therefore extrapolate from there onwards about its performance and how, at the end of the day, that country's currency will behave. Okay, so as we mentioned last time, there are three main types of economic indicators, and more than that, but still, the three main ones are what we call leading indicators. They give you some sort of hints of what to expect throughout the future. Okay, meaning, for example, some sort of survey, okay, much like the PMIs, okay, or if you looked at today's, for example, releases from Germany, the IFO indicators, they are consumer expectations, so it's in the name. They are, in a sense, some sort of survey asking consumers of that specific economy or that country how they foresee, for example, inflation, okay, behaving in the next year or so, the next 6 months or the next 3 months, okay? So they are, in a sense, gauging how market participants, how consumers within that economy's sentiment is, okay, and where they see that economy performing in the near future, okay? So it's a gauge of morale, if you would like, okay, or sentiment. That's how we call it, okay? Another indicator, another type of economic indicators is what we call lagging indicators. In a sense, they are exactly what the name suggests. They are from the past, okay? They are lagging, they're not up to the present. So in a sense, they compile information that happened in the past. For example, widely known lagging indicator, and one of the most important ones, as we just mentioned last time, was the GDP, okay? So in a sense, the growth kind of trajectory of a country, okay? So it's measured by the gross domestic product, or in other words, the GDP. So it's, in a sense, a lagging indicator because it compiles information from the past, okay? So it goes primarily on a quarter-on-quarter basis. And we mentioned last time that, for example, the UK's economies, the Japanese economy last week, we saw them being confirmed falling into what we call, in the grander scheme of things, recessions, because they have posted 2 consecutive quarters of declines, of negative growth rates, okay? So again, if you remember what we said in the past, 2 consecutive quarters of negative GDP, okay? Economists brand this kind of development as a recession. And as we mentioned, recession is definitely not a good thing. Some may say it's an essential aspect of economic markets, okay? But at the end of the day, that's it. It is what it is, okay? So other kind of, the other category is what we call coincident indicators, and you can see industrial production being one of them, or NFP, the non-farm payrolls report coming out from the United States economy, are a few examples, okay? And primarily we're going to talk about employment today, so you're going to see NFP throughout this session a lot, okay? So this has been the brief update on the definition, okay, of economic indicators, what is their nature and why we care about them, okay? We give you 3 main categories of types of economic indicators. Let's move on to the next topic, which is the categories of economic indicators. Last time, as I mentioned, we talked about growth and output, okay? We talked about GDP, okay? We talked about PMIs. We talked about manufacturing and services PMIs, okay? We've talked about many stuff. We also covered the area of inflation, or the category of economic indicators, which is primarily concerned with inflation. We noted CPI, we noted PPI, we noted core PCE. If those terms are not yet familiar to you, please go ahead and rewatch the last video, the last session we had. Okay, it's widely available on the internet. You can Google that. You can get that recap. What are they telling us? How are they comprised? And what kind of information and reaction we can expect from the results of them? Okay, so we're not going to go into that today. today we will focus primarily on the last two categories, which are employment, super important, and consumption. I mean, all of them are super important. We're going to focus on the last two. So again, yeah, we will focus particularly in the last two, employment and consumption categories, going over the key metrics that fall under each, describe them, interpret them, and this is an attempt to understand how they affect the FX market and their respective countries' currency. Okay, same kind of rationale, same kind of approach here. So let's start with employment. Okay, definitely a crucial category. Okay, so the most widely known or the most widely looked upon kind of economic indicator that comes out periodically, so on a monthly basis, is what we call the unemployment rate. I'm pretty sure all of you guys are familiar with the term unemployment. It's pretty much there in the name. It measures, in a sense, how many people are not having jobs within that period within the market. Okay, simple as that. So it measures the number of unemployed people as a percentage of the labor force. So for example, we're talking about people that are able and they're willing to work and receive money, okay, as we call the normal kind of situation across countries. Okay, so labor force, what we talk about when we talk about labor force, we're talking about the people between the ages of 18 and 65, depending on the country. So the time you are able and legally, let's just say, validated, okay, to work, which is the 18 years, okay, and the time you go to retirement, which is what, 65, 67, depending where you are, okay? So we're talking about, this is the labor market. These are, in a sense, the group of people that can and are willing to work, okay? So unemployment measures how many of those people in total between the ages of 18 and 65 can work, but they choose not to, okay? So it comes as a percentage, okay? So one thing to remember is that the rate is not measuring the unemployment in the past of time, but it's more like a snapshot of the current situation. So, or if you prefer, the months it relates to, okay? So it's not a sequential kind of adding on or a cumulative kind of figure. It takes from January until February that month, how many people were not employed, okay? This is what the unemployment is. So at the end of the day, as you can extrapolate by logical or deduction, okay? So a high unemployment rate, a high percentage of unemployment is obviously not good for an economy. And if that's not clear to you, allow me to explain why, okay? So the whole concept of growth within an economy stems from how many people you have in that economy which are actually partaking in activities within an economy. And by partaking activities, we're talking about consuming stuff primarily, okay? That's why consumption is also super important, which is the next topic. So in a sense, the rationale is the more people you have within an economy that are actually working and they're getting compensation for their efforts at work, okay? The assumption here is that the more people are actually willing to spend that kind of money, okay? So if more people are employed and they get money, more people will be willing to spend money and possibly more money, depending if they got raises and all that kind of stuff. So therefore, that kind of contributes to a higher consumption rate within the economy. So a higher consumption rate within the economy means you buy, for example, not only goods, but also services, which if you are performing well as an economy, so not only on a consumption level, but on the manufacturing stuff as well, on the production of these goods and services, you tend to create a positive kind of feedback loop. So the more consumption you have within the country, that drives even growth to a higher level, okay? So in a sense, for example, the US economy, if I'm not mistaken, is primarily concerned with 70% of them is stemming from consumption and no investment. So the higher the consumption rate within an economy, the higher the growth of that economy is expected to be. Doesn't mean it's going to come out like that, but the expectation is what is important. And we noted the importance of expectations theory in the prior webinar. Again, if you're not recalling this, please feel free to watch it once again. So again, a rise in the unemployment rate is definitely not good news, okay? But we're not taking this from an absolute point of view, okay? A number in and of itself says something, but it doesn't draw the entire picture. So we need to study how the unemployment rate is behaving across time as well. So for example, if you have an uptick, so means a higher unemployment rate in an economy, okay, let's say it went from 3.5% to 5%, obviously that's not good news. But if you pull up and zoom out, okay, and you see that, you know what, the 3.5% was the lowest unemployment rate ever in the history of that kind of country, and the 5% is more like the average, okay, that says a lot as well. If the 5% is something, the 5% unemployment rate is something that economy has not seen before, is even more important, okay? So there is more stuff than just the actual number. It's just you have to marry all these kind of things together in order to get the holistic view, which is at the end of the day what we're trying to do here. We are concerned, yes, with the individual figure, but we also care about the macro level. Okay, so let me go ahead and please read out the interpretation. So usually a rise in the unemployment rate could, and this is an important aspect, could doesn't mean it's always there. So maybe a negative signal for the currency it relates to, as it would imply that the unemployment has risen in relation to the total workforce, obviously, with possible adverse effect on the growth rates of an economy. Okay, so on the contrary, a lower unemployment rate is, on the flip side, good news for the economy. That means more people are actually working, and we make the assumption that more people are going to be working, more money they will be receiving, therefore more consumption, which will lead to higher GDP or higher growth of that. Okay, pretty much that's it. Pretty much is nothing crazy. Okay, so let's study. Let me get my pen out here. Okay, so let's study the actual economic indicator. So economic indicator is this. This is by the way, I've taken a snapshot from invested.com. This is my preferable choice of keeping track of how economic events unfold. Okay, you can use whatever you want, Forex, what is it, Baby Peeps, Forex.com and all that kind of stuff. They provide you with calendars, which are scheduling what kind of releases they come out. Okay, I've chosen invested.com. I don't know. I just chose it from the beginning. I stick with it. So we're talking about the unemployment rate for the month of October from the United States. And you see here also of critical importance, you give them 3 stars, obviously, because it's a super market kind of moving, or has high weight in regards to how an economy is performing and therefore its currency. So you measure that by giving them stars. How critical is it? Okay. So in a sense, we have the prior figure standing at 3.5%. The forecast was for it to rise to 3.6%. So 0.1% rise of the unemployment rate. Given this forecast in and of itself, we would expect to see weakness of the United States dollar. The actual result was even worse than that. Worse, obviously, because it rose, as we just said, is the relationship between the currency and this particular release is negative. It's not a positive relationship between the two. That means, obviously, if you have a high unemployment rate, that could lead to a weakening of the United States dollar. And at that point in time, if you have this kind of release, you would have reasonably expected to see the dollar weakening, okay? Mainly because of the reasons we just outlined, okay? So again, this is how we read them, okay? We have the forecast, we have the prior figure and the actual figure. So deviations between the forecast and the actual is what kind of moves the market. It forces those that have taken the negative stance in regards to the dollar see validation, okay, given that we have a deterioration of the unemployment rate. It rose, okay? So that means at that point in time, when the actual result came out and it was above the forecast, you would see a readjustment, a negative readjustment of the market. So those that said that the dollar at that point in time was expected to fall, okay, or the dollar index more specifically, at the time of this release, they had to adjust accordingly, even more negatively, their positions regards to the dollar, okay, because of the high unemployment rate or the higher than expected unemployment rate, okay? So enough about unemployment rate, obviously important. Let's do the historical overview, and then we're going to go to the NFP more specifically, more likely, okay? So once again, 3.5%, okay, yeah, okay, sure. It's an individual number, okay? What does it tell me besides this coming out hotter than expected or higher than expected? Therefore, we have to open up and see what's the historical kind of trend. Okay, we saw that the unemployment rate rose from the 3.5% to the 3.7%, above the 3.6% expectation. In the grand scheme of things, what does it tell me? If you look at this trajectory of the unemployment rate, okay, and you can also see the level before that, okay, it's pretty much around the same kind of level, okay. So this, as we all know, this is where the COVID pandemic kind of hit. Obviously, everything was closed down. People lost their jobs. More people are unemployed within the market. You see a spike of the unemployment rate. In hindsight, this was super, super obvious. At that point in time, what we cared about was flashing rate crisis before our eyes, or there's going to be doom and gloom and all that kind of stuff. After that, however, you see that things got back on track. Businesses started to open once again, as we saw this kind of relieving of these kind of draconian measures in regards to COVID or the pandemic. We see a gradual reopening of the economy. More people got back to their jobs. So therefore, obviously, you see the unemployment rate down ticking. And through a period since 2021? Oh, no, 2020. Okay, early stages of 2020 until, let's just say, a few months back, you see this gradual moving back in the opening up of the economies. Therefore, you see the unemployment rate easing back down towards the historical average lows, okay, which is this area we see here, somewhere around between 2.5% to 4%, okay? So in the grander scheme of things, we're back at normal, even though we see an uptick of the unemployment rate from the 3.5% to the 3.7%, okay? That in and of itself says something, but in the grander scheme of things, we see, okay, same stuff. Nothing crazy has shifted. Therefore, you won't see a radical kind of reaction from the market because it's within the normal quote unquote bounds. If, for example, this went from 3.5% to 5%, that would have been a problem because you see a reacceleration, if you would like, of the unemployment rate, which is definitely not good news if it makes that kind of jump above the historical levels. Okay, so we have to become confident and able at zooming in and out at all times and get the whole picture of what's going on. Okay, that's why we use this historical point of view as well. Okay, so pretty much you can see the same thing. Moving on. Another super important aspect of what we call mainstream or the status kind of quo of employment reports. By the way, these are aspects of the employment report. Unemployment rate is one aspect. More specifically, we're talking about the US here. Unemployment is internationally based. Every country has an unemployment rate. NFP, however, only the US has. Okay, so it's non-farm payrolls. Certainly you have heard about NFP Friday. It's a release that comes out the first week or the first Friday of each and every month. So that's something that attracts a lot of attention from market participants. Okay, but at the end of the day, non-farm payrolls, the unemployment rate, and you're going to see soon I don't have it in here. The average hourly earnings are three components of one report, which is called the employment report or the labor market update, which comes out from the United States, more specifically because it has the NFP. But all other nations around the world, whether that we're talking about Australia, Germany, the UK, Eurozone as a whole, or China, whatever that is, they have pretty much the same kind of components of unemployment report. So they have unemployment rate, definitely. They have a release regarding to the salaries. So what we call average hourly earnings. It varies through economies what the name is, but in a sense, they keep track of how much or the rate of change of or the growth of salaries within that economy. So that's the second. And the third one is primarily, much like the NFP, how many jobs or how many available jobs have been created within that period of any given kind of economy. In the United States, it has the term non-farm payrolls. If you go to the UK, it's called employment change. It's exactly the same thing, okay? It measures how many jobs were created within that period, okay? NFP has a little bit more fine tunings to it, but we will see them right now, okay? So the NFP figure, which is short, is an abbreviation of the non-farm payrolls. If you look at this kind of definition by in and of itself, you see that non-farm means we're not talking about agriculture kind of jobs. So it's everything else. Basically, it's everything excluding the non-farm, excluding the farming industry, and you will see why. So non-farm payrolls is a key indicator primarily used in the United States employment market or the employment report, whatever that is, despite being used also for other countries as well, okay? So it measures the change, this is what it measures, in the number of people employed during this surveyed month. So keeps track how many people got jobs or not, okay? So excluding, this is the crucial aspect, excluding the farming industry. And the main reason that it excludes the farming industry because we have what we call a high seasonality effect. For example, if you're running a strawberry farm, okay, you're not going to be working throughout the entire year because crops are seasonally dependent. Okay, so strawberries come out this kind of period. Okay, so let's just say January, February. Most you can find them at in March. Okay, so all the other 9 months, all the other 8 months, the remaining months of the year, strawberry farmers are in a sense laying back. They're not doing anything because you cannot yield any crop throughout this year due to the seasonality effect, due to temperatures, due to climate and all that kind of stuff. Okay, so it's not about only strawberries. It's pretty much about everything about the farming industry. The strawberry farms was just one example. So you get the point. So what's the point of including this kind of farming industry if this month is they are in business and they employ more people in order to harvest the strawberries, okay? And include them in, for example, the August report where they are not working. Obviously, it gives you a variation that is unwarranted, is not wanted, it distorts the picture. That's why you have the non-farm payrolls, okay? Excludes this seasonality effect out of the picture, and you have in front of you, in a sense, the jobs that are not seasonally dependent. Okay, so the jobs that go from January until December without interruptions. Okay, interruptions mean they work normally. That's the whole point. Okay, so that's why it's included. So it's to eliminate these kind of distortions of the figure. That's it, enough. So practically, the indicator is measuring the US employment ability to create jobs. At the end of the day, this is what it's telling you, NFP report, NFP print, whatever you call it, which has also an effect on consumer spending. And remember, it's pretty much the opposite case we made with the unemployment rate. So more people getting jobs within that specific time frame, that means more people are willing to spend money. That's an assumption. More people have money to spend, higher consumption. Higher consumption leads to higher growth. Okay, the rationale is pretty much the same. Okay, so something else to remember is that it's released on the first Friday of every month, and it's very closely watched by investors. if not the most watched upon kind of release. If it's not NFP, it's probably GDP. Okay, those are the two giants in a sense that drive markets depending on the results. Okay, so not only investors are watching this, but also the Federal Reserve or any central bank. If you're, for example, in the UK, it's going to be the Bank of England, and they're going to be looking at the employment change metric, not the NFP because they don't have NFP. Okay, but it's also used by also policy makers because again, it gives you a status update on what's going on with the people of that country. That's why we care about the employment. So it's also worthwhile remembering that the change in this indicator can be very volatile. That's definite. Go back and look what has happened with the NFP print of for the month of January. We saw once again a blowout NFP report above expectations. So expectation was it for something around the 170,000, and the actual result was 360, so almost double than that. Has severe implications on the perception of the market of how an economy is behaving. Okay, so this indicator can be very volatile and could create wide market distortions with ripple effects also felt not only in the FX market, in currencies, but also in stock markets. Okay, so if, for example, again, if you have an NFP release, you expect that 200,000 new jobs were created within that period, okay? And the actual result comes out at 50,000, so 150,000 less. It will have, that's a definite, it will have a severe market reaction, not in the FX market, but also in your stock markets. And you may ask, why? Okay, obviously, if people within that economy, if the US economy, for example, did not create as much jobs as expected and more people left, okay, so that could translate into higher unemployment rate as well. That means less people have money, okay, less people have money, less consumption, blah, blah, blah. But from a company's point of view, this might tell that companies may have started to cut jobs because they are overpopulated or overextended, if you like, which is definitely not good news for companies by themselves. Share price may rise because of lower costs. If you have a lot of people and you start cutting jobs, that could create some sort of synergistic conditions for a company. You may see stock rising, but on the grander scheme of things, less people working is definitely not good news for international investors, okay, or international businesses that want to set up their operations in that country, for example, the United States, because that will have a negative impact on the growth aspect of the economy. So therefore, they will not be willing to enter that kind of market. Okay, so you're going to have some sort of ripple effect on your stock markets as well. So interpretation is, should the reading of the indicator rise more than the market expectations? So it's not about this versus this, is forecast versus the actual. Okay, so if it rises more than market expectations, we expect to see strengthening of the United States dollar in this particular case because it's NFP. If it's the other case, weakness for the dollar is expected. And once again, we're talking about expectations theory. Once again, at that point in time, okay, the release for September. September's NFP report recorded 315,000 new jobs were created. The forecast for the October report was 200,000. So you see, from 300 we go back down to 200. So you see the market moving, okay, in a sense, pricing in this kind of expectation that we're going to see worsening labor market conditions in the United States. Therefore, within that period between September and October, using only one metric, which is not the actual representation of how markets behave, you would have reasonably expected to see the market participants expecting weakness in the United States dollar. At the time of the release, however, when the actual figure came out, okay, you see this kind of gradual edging towards this report for the month of October. You see the actual result beating expectations by 61,000. Okay, so they expected deterioration. Okay, but the actual figure said, you know what? No, we've performed much better than expected. So at this point in time, when you have opened, if you have been present at this release of the NFP, you would have seen a not super, but a strong reaction, a strong positive reaction in the United States dollar. Okay, because you see the reassessment. Okay, we expected worse, but it became better. You see the rapid correction of the market's path. Okay, taking into account the new incoming data, which is better than expected. Okay, so at this point in time, we would have expected strong results, strong move by the United States dollar. And we make a case here, if the unemployment rate downticked and if the average hourly earnings were higher. Okay, the other aspects of the report, because it's not only the NFP figure by in and of itself. We're talking about, once again, zooming out and taking into account average hourly earnings, unemployment rate, and non-farm payrolls. But at the end of the day, and the NFP grabs most of the attention. Okay, because we're talking about how many people are employed, more people employed, more consumption, etc., etc., etc. Okay, so enough about NFP. Let's move on to another report that comes out on a different time. Most of the times comes within the week prior to the first, prior to the NFP print. Okay, it comes in the same week, this ADP report, that with the actual employment rate. So ADP employment report is another US employment market metric and is announced every month, same week as, most of the times it's the same week as NFP. So it's a private sector measure. Okay, NFP, it comes from the National Bureau of Statistics. So it's a governmental kind of agency, whereas ADP comes from the private sector. So they are, in a sense, pretty much studying the same kind of phenomenon. They have different techniques of calculating what's the actual amount of people that were employed within the country. Non-farm payrolls comes from the government, branch of the government. ADP, it's an quote-unquote independent organization from a private sector, that studies the jobs of the private sector more specifically. Okay, so it's a private sector measure of the monthly change of the non-farm private employment. So it's usually released 2 days ahead of the official employment data. For example, you're going to see probably ADP coming up on a Tuesday and NFP coming up on a Friday. Okay, and is considered as a gauge of the NFP number. So in the past, we saw some sort of correlation between the numbers of ADP and NFP. So if you saw on a Tuesday that week where you have employment data from the United States, if you saw the ADP, okay, coming better than expected on Tuesday, market participants or economists in the past expected to see a higher NFP print on Friday as well. So it used to serve as a precursor to the actual NFP result. In recent days, in recent times, however, we see this kind of relationship fading away, even though you continue to see people reacting to ADP. In recent times, people say, oh, ADP is not important. But if you study market reactions, when this specific kind of metric comes out, you see the market reacting to it. So they say, well, we don't care about ADP, but at the end of the day, you see the market reacting. So it's up to you to place importance on this or not. I like certainly to take a glimpse of it. I don't place too much faith in it, but at the end of the day, I pay attention to it. You can skip this, okay? Up to you. I do this because I see, most of the times I see reactions in this or readjustment of the market. So once again, analysts tend to advise against interrelating these two indicators, as the correlation between them has fallen over the past few years. Yeah, that's a fact. Okay, so interpretation is, in a sense, a rise of the indicator is above expectations, is expected to provide some sort of support for the United States dollar, and the opposite case is made here. But ADP, But ADP print, you reasonably expect to see the United States dollar kind of coming under pressure, okay? Put it mildly like that, okay? So interpretation is the same. You look at forecast versus the actual. Let's not go ahead and do the same thing once again. I know it gets boring. You get the point. Positive relationship between the two. Higher number, a positive reaction. Lower number, negative reaction, okay? So ADP is another one. So we covered unemployment, NFP, ADP. The next one is jobless claims, okay? What we call initial and continuing jobless claims. So jobless claims is, if you remember, let's go back to the first slide. Where was it? Sorry, guys. Leading indicator, okay? It comes out every Thursday. Every Thursday of any given week, you're going to get what we call initial jobless claims. Again, they come out from the United States. Okay. So jobless claims, what are they? Okay. So at the end of the day, it's another metric of how an employment market of a country is behaving. So it's the number of people who have filed or are about to just say already filled their report or are about to fill their report for unemployment insurance benefits in the prior past week. So we're talking about people that, for example, they have been fired from their jobs, okay? Or B, people that say, you know what, I'm going to take a break. I'm not willing to work, okay? So for a brief period of time, whatever that reason is, maybe it's personal, maybe it's because they got fed up with working all the time. Whatever the reason is. So in a sense, it measures the people that go to the government or the government authorities or the relevant branch, or what you call this. I don't know exactly the name, the actual terminology. So in a sense, you go to the government and you say, you know what, I'm unemployed. I'm filing this report in order to get unemployment benefits, okay? Because I don't want to work for this period of time, okay? So this economic indicator, jobless claims, measures these kind of people. I say, I'm going to take a break or have been fired. I cannot sustain myself without governmental aid. So therefore, I go in and file for unemployment benefits. Some may lose their jobs or some may choose to leave their work and they don't file unemployment benefits and don't file in a report for getting unemployment benefits because they say, you know what, I'm going to take 2 weeks off and then I'm going to go back and find another job. These are people that have, let's just say, a much longer horizon in regards to their employment affairs. They are not willing to take a job as soon as they get fired or as soon as they leave their prior job. Okay, so they file for these unemployment benefits. So there are two categories of jobless claims. The initial, which is obviously initial says start. Those have measures how many people have filed for the first time for unemployment benefits. For example, you got fired last week or you left your job last week, you go this week and file for unemployment benefits, you're going to be counted in the initial jobless claims figure. Whereas you have on the other side what we call the continuing, obviously, those who have been fired, for example, or have chosen to leave their work a month ago, and this is the 4th week they have been filing for this report. Okay, so initial first ones, continuing those that obviously continue to do so. Okay, which consists of people who have been receiving unemployment benefits for a while. The period is not specified. Those are the people that continue to get benefits. Okay, so this release is on a weekly basis. Again, it's a leading indicator, and that's why we call them the weekly initial jobless claims. So at the end of the day, what is this metric telling us? Okay, people that are not working currently, okay, and they go to the government to file for getting benefits, insurance benefits. Okay, that means they're not working. That means they don't have, in a sense, as much money in their pocket, or they don't have this kind of steady income coming in each and every month, each and every week, because they don't have a job. Therefore, more This is something between the unemployment and in limbo, so somewhere in between. You will not reasonably expect these people that have filed for unemployment benefits to go out and spend way too much money or spend money at all. They might be on a cost kind of saving mode. Therefore, you would exclude them from the expectation that they will be buying stuff in the near future. Therefore, high initial jobless claims figures mean there is going to be reasonably expected less consumption. Therefore, you will not explicitly expect to see strong GDP growth of that economy. Okay, that is in a sense the same rationale. So if you see a higher than expected figure, that tends to weaken. So it's a negative relationship, negative, whatever that is, my days. So this is a minus, guys. I'm bored to write the whole thing. So in a sense, higher initial jobless claims figure, okay, tends to weaken the United States dollar, whereas lower initial jobless claims figure tend to boost the United States dollar. Okay, so again, comes from the United States, importance, critical. Jobless claims is the name of it. So you have previous forecast and the actual. This is lower than this. So the forecast was 225. The actual was 222. Lower than expected. Good news for the United States dollar, because again, the market moved in advance, expecting that the initial jobless claims is going to be higher than the prior month, even though you see, I failed to mention this. Sorry, guys. So prior result, you can see is 226 and the forecast is 225. Okay, 1,000 less. That's definitely good. Okay, for the US economy, because you have 1,000 people less filing for unemployment benefits. Why, however, you see this kind of positive reaction afterwards is because you see this number, you see the color of it is 226 and it's in red. Okay, this is in a sense what we call a revision. So last week's number, for some weird reason, it was calculated differently. So obviously we're humans, we do make mistakes. The last month's figure was posted, for example, at 230,000. Okay, and this week's report was showcased that, you know what, last week's 230,000 were actually 226. So we're gonna revise it downwards to reflect the actual filings of the prior week. Okay, so in a sense, keep this in mind whenever you see these economic news releases and you see a prior figure, okay, having a green or a red number, not being blunt like this, the 225, that means the prior figure was revised either upwards or downwards, depending on the color. Okay, so something else to keep in the back of your minds. Okay, it serves a purpose as well, and it serves much more. It has more gravity in regards to NFP more specifically. If you see revisions of prior NFP figures, that tends to distort the picture as well. Okay, so keep an eye on that as well. So the color of this is also important. But yeah, I hope you understand how you interpret the whole thing. Yeah. Let's move on to the next topic. Next slide. Another employment market update is what we call the JOLTS jobs openings. Okay, these, as we mentioned, we have NFP on a Friday, ADP on a Tuesday. Okay, JOLTS comes out on Wednesday. We're talking about the same week now. Yeah, the first week of the month. Okay, most of the times it's like this. So JOLTS is another report. So you have ADP, JOLTS, and you have NFP. Okay, so JOLTS jobs opening is a survey that we have to notice, which helps keep track of job vacancies positions, in a sense, available in the US labor market. It collects data from employers, not from employees, not from consumers, not from day-to-day stand-buyers, about employers, those people that create the jobs, in a sense. And it collects data from employers about their business employment, or jobs openings, which is the name, job openings, recruitment, hires, and separation. Separation means headings, okay? Yeah. So essentially, JOLTS defines jobs openings as all positions that are open but not filled, okay? So you post something, I don't know, on LinkedIn or your local kind of agency that brings to the market kind of job opportunities, okay? And it's about on the last business day of every month. So it's an accumulation or a survey of how many openings or job openings from an employer's point of view have been over the past month, okay? And you have specific criteria. So a specific position exists and there is work available for that position. So you don't just open jobs for no bloody reason. You have to have a valid reason why you do that. You're looking for a specific quality within a person, then you create a job, okay? It's not random creation of jobs. You have to actually back it up, okay? So a job could start within 30 days. That's another parameter. Irrespective of the establishment, find suitable candidate within that time. If not, you're going to have that entry into the future as well in the next month. Again, super detailed stuff. No need to know all this kind of stuff, but you have to get the gist of it. So there is active recruiting for workers from outside the employment establishment, location that has an opening. So in a sense, you have contractors doing the job hunting, in a sense. Okay. So nevertheless, at the end of the day, the interpretation is pretty much the same in regards to ADP and NFP. So a higher jobs opening number, an actual higher than the forecast, that's good news for the economy. Therefore, you're going to see a stronger United States dollar. It also comes only for the United States, by the way, these JOLTS, like the ADP and the NFP. Okay. So once again, the relationship is the same, higher than the expected positive. You look at the prior as well. Yeah. Negative or below the actual figure is below forecasts. Negative reaction in the United States dollar. Okay. Enough about employment. Oof. Talking way too much. Let's go on to the next topic of conversation. Next category, which is consumption. Okay. The primary metric, or the most widely known one that obviously you've heard me talk about throughout the employment section as well, which we're talking about higher consumption levels. Yep, this is it. And the primary indicator for gauging of how consumption within an economy is behaving or is expected to behave is what we call retail sales. Okay. Retail sales. So the primary metric when it comes to consumption indicators are an economy's retail sales. Okay. They measure the purchases, okay, buying of finished goods and services. When we talked about finished goods and services? Oh yeah, GDP. That's the relationship. That's the link between the two. Okay. So they measure the purchases of finished goods and services by consumers, us, okay, and businesses as well. So by measuring consumer demand, so this is essentially what this metric calculates in a sense, indirectly, okay? So by measuring consumer demand for finished goods, retail sales help gauge the pulse of an economy. So obviously, given this sentence, strong retail sales, pulse is high. That means the economy is thriving, okay? People are spending money, okay? Which is good news for the GDP. That's it. So it should be noted that the rates could be distinguished from headline rate, okay? We noted this in the past, which tend to include a broader spectrum of products, and what we call the core rates. Whenever you see core before any given economic release, you know it is stripped of something. And that something most of the times is an aspect that is quote unquote volatile, or at least has the implication of distorting the picture. Okay, so in this kind of case, when it comes to retail sales, we talk about automobiles. So you don't go out each and every weekend, you buy a new car. Okay, so it comes out periodically. That's why you use the core retail sales to strip out these kind of one-off purchases. Okay, and also gas stations. Obviously, you talk about gas. If the price of oil is high, that in this particular period, let's just say, actually it's kind of the opposite now. It's kind of eased compared to 2022. Okay, so that's why you use the core rate to strip away this kind of volatile or once-off kind of payments that consumers, much like you and me, are doing or going out and doing, consuming each and every month. Okay, so it excludes automobiles and gas stations, whereas the headline is pretty much everything. Okay, so overall the rates are usually being issued on a monthly basis, but also on a year-on-year basis. Where you place your faith or your importance or more attention depends obviously upon the interpreter, you and me. Okay, those participants that look at, those fundamental analysts that look at this kind of data. But most of us, I'm talking about myself here and only myself because, I know what's going on. I'm placing a lot more attention on the month-on-month figure, okay? Because it's super kind of tricky. Not tricky, but it's the most, from my point of view, from my standpoint, is the most reliable kind of gauge of how consumers have behaved within that period rather than the year-on-year. Because the year-on-year can be distorted because you're talking about retail sales of January, February, March, blah, 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 until December, and you divide that by 12. Okay, so you get the average down. You get a watered down kind of metric. Okay, useful, yes. As important as the monthly, from my standpoint of view, not that much. Okay, so that's why I pay attention a lot more to the monthly. Okay, you can use the year on year, up to you. The point is to know how to interpret it, know what it tells you. Okay, so in a sense, the interpretation is an acceleration of the rates, retail sales, beyond market expectations tend to create support for the respective currency and vice versa. We explained this a million times. It's an exaggeration, but we've explained how they impact an economy many times in this webinar. So core, you see here, core retail sales month on month, interpretation is pretty much the same. And you see, let's do the example from the UK, so GBP. We're talking about the pound here. How is it going to react to this release of core retail sales? Core retail sales excludes automobiles and gas stations and energy and all that kind of stuff. So you see, prior month was negative 1.7%. When was this? For the month of September, at a period where the United Kingdom was on the verge of a recession. You wouldn't have expected to see strong retail sales for the UK economy. That was the confirmation. You expected to get some sort of improvement, but still, if it's below zero, if it's negative, that means people are not willing to spend money and they are not actually spending money. That's a bad omen. So you pay attention to this. And the actual forecast and the actual result was even worse than the forecast. Okay. So at this point in time, you would have reasonably expected to see the pound weakening, and kind of substantially, to be honest. And after that, if you paired that with forecasts about GDP, you would have expected to see weakening of the growth rate as well, because they are interlinked. Okay, so again, at the same time, at the end of the day, the interpretation is pretty much the same. The relationship is positive. Higher retail sales tend to boost currency because of the expectation for a stronger GDP growth of an economy. Better health of an economy, okay? Because consumption, or in the form of retail sales, are the primary kind of driver of growth of many Western European nations, global nations. We have to be clear about this. The system that is built upon the capitalist system is actually feeding off this consumption kind of trends, and that's why we see growth or recessions and all that kind of stuff. Okay, so I think we're done here. We get the point of core retail sales or retail sales in and of themselves. Okay, same rationale. Another lovely, and it's definitely lovely, consumption metric is what we call consumer confidence indicators, okay, or indexes or indices. Okay, so another consumption metric is what we call consumer confidence. So tells you exactly what it measures, okay, which tend to measure, no pun intended, sorry guys, the level of consumer confidence in economic activity. So we're talking about how consumers feel at that point in time about their economy and their willingness to spend, okay? This is what this measure gives us. And again, it's a leading indicator, okay? So practically the indicators are formed by surveys. So whenever you see, if you read the definition of any economic indicator and it says survey, most of the time, not all of the time, most of the time it talks about what that studied person or people or group of people are expecting to come into the future. Okay, and this is the importance of this indicator. It gives you snapshots of what to expect, how the consumers are expecting for their economy to behave in the future. That's why that is super important, because if I'm, for example, pessimistic about the current situation right now, and I'm saying, you know what, the situation is bad and I expect it to get even worse, I'm telling you indirectly that I'm not willing to spend money. And therefore, you would expect those that compile this survey and give us the information, you get, in a sense, the forecast of what the consumers are going to be behaving, how are the consumers may be behaving in the near future. Okay, so if I'm not willing, if I'm pessimistic, I'm not gonna be willing to be spending as much money. Therefore, you would reasonably expect, because I'm a citizen of whatever nation, the United States, the United States kind of retail sales or consumption is going to be lower. And we're not talking about me and only me. We're talking about the accumulation or the collective kind of sentiment of the consumers of that country, of that economy. Okay, so practically the indicators are formed by surveys used to measure the degree of optimism of consumers in the state, on the state of the economy. So, for example, the Eurozone, the reading is compiled from a survey of about 2,300 consumers. And now I know, if you are a statistics kind of fan, or not fan, but you get a grasp of statistics, you're going to say 2,300 consumers, are they enough, or are they representing the actual boots on the ground of consumers of that country? I don't know. I don't know the answer to that. The point I'm trying to make here, I'm kind of skeptical as well about the collection methods first, and about the people or the sample size in statistics kind of terms of the people that were studied and asked. If you went somewhere and you found a group of people that are super pessimistic, obviously the results of that study is going to be bad. You see what I mean? But most of the times these surveys are conducted either electronically or on a kind of interview-like kind of setting, for example, in malls where you go and see and find people that are actually willing to spend, which is kind of paradoxical in the first place, and ask them how they feel about the economy, blah, blah, blah. Okay? So again, so the reading in Eurozone is a survey about 2,300 consumers of any given nation of the bloc of Eurozone, which asks respondents to evaluate future, super important, future economic prospect. Not now, okay? They start from now, but they project into the future. So it's about the future. It's a leading indicator. And that is why it's super important. So higher readings point to higher consumption optimism. Okay? So overall, the degree of optimism or pessimism, okay, characterizing the average consumer in an economy may have an impact. And you say here, may. And I gave you the reason why, because it's just statistics at the end of the day. It's not okay, you're going to say it's a bell curve kind of distribution of people within the economy. Fair enough. But still, May does not give you certainty. Something else to keep in the back of your mind, okay? Not because you see a consumer confidence indicator of the, for example, Germany being super, super bad, it means that's actually how it's going to come out. May come out like that, okay? The wording is crucial, okay? So it may have an impact on retail sales and hence to the contribution of the average consumer on the growth of the economy. I'm not going to go over this once again. You get the point. So interpretation is obviously how optimistic a consumer is, okay, or higher than expected reading. It's a greater degree of optimism, stronger currency or strengthening of that currency. Okay. In this kind of case from the United States, the preliminary, this something else. Again, I failed to mention, you have preliminary and actual and final results. Fear not, but make this a mind note whenever we're talking about leading indicators, more specifically, much like the consumer confidence or the IFO or the University of Michigan, consumer sentiment expectations and blah, 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 blah. We definitely look at the preliminary, which is in a sense an early kind of survey, okay, the early result, because we're talking about leading indicators. The sooner you get this information, the better. Okay, so I don't care about a consumer confidence indicator for the month of February because we are on the 3rd week of February. I don't care about that. This data is obsolete. If, however, this kind of indicator, the consumer confidence indicator, comes out in the 1st week of March and is about March, you have the entire month in front of you in a sense. Okay, and that's how and that's why these releases are scheduled at the early stages of any given month. Okay, so the preliminary, the P next to the release, as again something you have to keep in the back of your mind in regards to leading indicators. Okay, so from here we have CB, consumer confidence. It's an indicator from the United States, and you have also the University of Michigan, consumer sentiment. You have inflation expectations. You have many other stuff coming out from University of Michigan, and more specifically, University of Michigan has been observed in the past to create some sort of volatility in the market because obviously it's super important. It's a leading indicator, gives you a glimpse into the future. Okay, so in this kind of case, we see once again the actual forecast becoming less than the expectation, less than the forecast, negative for the United States dollar. If, for example, this was 60, that would have been green, obviously, and you would have expected to see some sort of support for the United States dollar. Okay, moving on. We have another indicator, it's not leading, it's much more like a coincident indicator. We call current conditions. Talk about now. So business conditions indicators are being compiled usually by, once again, surveys, and are supposed to show the current, not future expectations like this. Current, boots on the ground, what's going on right now. Okay, so and it's about businesses, not consumers, businesses. Okay, another important aspect of the whole economic infrastructure of an economy. Okay, so they tend to be found in several slightly different variations depending on the economy surveyed and the organization performing the survey. At the end of the day, they talk about the same thing. Boots on the ground right now. What's happening? They ask businesses, which are the ones that provide the goods and services that consumers, much like you and me, are buying on a daily basis or a monthly or a weekly basis. Okay, so this is from the business's point of view. Much like on the prior webinar, we noted about CPI, consumer price inflation, and PPI, the producer's price inflation. They talk about inflation, yes, that we're talking about in that reading of the prior webinar now. They are both talking about inflation, yes, but one is from the consumer's point of view and the other one is from the producers or the business point of view. Okay, so one is consuming, one is providing. okay? And you get what we call the intermingling or the intersection between demand and supply and all that kind of stuff, okay? So they are released on a monthly basis. And once again, the interpretation is if you have optimism, okay, or improving conditions, okay, in regards to the expectations, okay, that could provide support for the currency, while a drop of market expectations could weaken the respective currency, and it is regarded as a negative sign. Okay, so look at Germany's TEV current conditions. Germany is definitely under deep water in the past, 3 quarters, at least maybe a year now. There's severe underperformance from Germany, which is worrying for European citizens. Okay. So we're talking about the euro here. This is Germany. Okay. So we have the German TEV current conditions, and you see the previous is in the negatives, 72.2. The scale is between 0 and 100, if I'm not mistaken. Not sure about this, to be honest. But obviously, the higher the number, the better. The lower the number, so it's not between 0 and 100 because it's below 0. Okay, so there's no scale here. So the extremes do indeed matter. So we have a negative 72.2, okay, reading for the month of October. This is for November. The forecast was a slight improvement. Okay, so it's 68.4 there. Sorry for smudging it. Okay, so yes, the situation is bad, but the expectation is for a slight improvement. Okay, you're still in the negatives, but we're talking about a slight improvement. The actual result was better than that. So even better improvement was undertaken. So in this point in time, this has been slightly good for the euro because it comes from Germany. And in the grander scheme of things, this did not, I remember this clearly, did not move the euro an inch because you have deteriorating manufacturing capabilities. So other aspects of the economy are super, super bad. And you get a current conditions kind of metric saying, oh, you know what, we have improved slightly. Nobody cares about that. In the grander scheme of things, it matters. Okay. So this kind of report gets squashed by other more important aspects and more important stuff, much like CPI or inflation, more specifically because it comes from Germany or the European of a member state of the European continent of Eurozone. Is not CPI, it's HICP, same thing though, measures inflation, or from a GDP point of view may have been bad, or from a manufacturing front may have been bad, and they have been bad. So therefore, in the grander scheme of things, even though you have improved, quote unquote, current conditions as a result from the TEV economic current conditions sentiment indicator, this is not enough to support the euro. Okay. So again, everything comes together. So moving on to the next, we have, let me see how many, this is the last slide, guys. So please bear with me. I've gone way ahead of my time once again. So last one is economic sentiment. Okay. So we covered current conditions, we covered consumer confidence and the retail sales. Let's go to the last one. There's many others, by the way. I just chose these 4 for this consumption kind of bracket. So economic sentiment indicators tend to measure optimism. Okay, so you are gauging the psychology of the market once again. Okay, characterizing once again businesses in an economy usually over a short-term period. For example, the next 6 months. So we're not talking about years down the line. We're talking about the immediate future, okay, short-term future. So again, economic sentiment. What's going on in the greater economy, okay? It's not about current conditions, okay? So should the indicator reading once again show that business remain optimistic? So in terms of production, in terms of buying raw material and creating these goods that will be supplied to the market. So the higher the optimism, the better it is, okay, for a country's currency, because it gives hope or optimism, or it serves as a positive sign that economy is going to grow. Okay, thus it could provide support for its currency and vice versa. Once again, we have here Eurozone as a whole and Germany, which is part of Eurozone and has similarly the same currency, Euro. Okay, so both fronts, deterioration in the negatives, some sort of improvement is expected. Actual result was much better than expected. Again, very nice. But if you have troublesome conditions on the on the grander scheme of things, this is not expected to provide, any sort of major reaction, or at least shift the euro to a new trajectory based solely on this. So you have to take this on a grain of salt. If you have all of this, okay, economic sentiment, current conditions, consumer confidence, retail sales, all of this, okay, posting positive results month after month, recovering in a sense from a downward kind of trajectory and bottoming out and recovering ground and rebounding to high ground, then yes, it's fair to say that you're going to see stronger reactions in that country's currency, which is in this kind of case the euro. Okay, whereas if it's mixed and match results, don't expect to have some sort of volatile reaction. Okay, so hopefully you understood what we talked about today. We've done employment, we've done employment was the one category, consumption is the other one. We covered many stuff that are released periodically and are widely and easily and freely available in the market for you to keep an eye out and do your fundamental analysis. And we have to close by saying where you can find this information. I said we're not affiliated with any of these kind of companies, any of these websites. I just came across this when I first started doing this. Okay, so I'm convenient and place more reliance on this. Many platforms now have integrated calendars where you can keep track on the schedule of economic releases. You can use that. Doesn't matter. The same expectations, the same. Rarely you're gonna get some sort of deviation when it regards to expectation. But yeah, the schedules are there. They're free for you to use, adjust them accordingly. For example, you don't want to be looking at how at the economic releases coming up from Japan because you don't like Japan, whatever that is, I don't know, or Germany or the United States, or okay, you can adjust that accordingly. You can find these kind of sites as one of the most reliable ones. I like to use this, but at the end of the day, please use a calendar if you're willing to do this kind of fundamental analysis. I think you understood the benefits of undergoing this kind of analysis, as we just went over in the past few sessions together, past 2 sessions more specifically. Use fundamental analysis, please. It's gonna definitely elevate your game to a new level. So they're there. We have went over together and presented them, analyzed them, and managed to get a rationale of how to interpret them. Super easy to use. Please go ahead and do this. And please don't rely purely on technical analysis. If that's what floats your boat, fair enough. But if you have this kind of available data in the front of your eyes each and every day, why not use it to your benefit? Okay. So plus you learn a lot more stuff and understand how the cogs of the machine are working, and therefore you can make much more informed decisions while taking into consideration economic data, okay, with and applying it and marrying that with technicals rather than just doing technicals by itself. Okay, so there's a synergy between the two. Why not do it? Okay, so I've blubbered way too much on this webinar. Once again, sorry for dragging this way too long, guys. Hopefully you have enjoyed this. Hopefully you understood the concepts that we introduced today. And if not, if you have any sort of given questions, please send them through. If you want to rewatch this kind of webinar, it's going to be live in a few hours' time. You can study the past ones as well. In the next week, oh my days, next week we're going to do, if I'm not mistaken, we're going back to technical analysis and we're going to do super basic stuff. If I'm not mistaken, I'm going to do how to place trend lines, identifying the main trend, use support and resistance levels, and possibly some chart pattern identification. If you want to tune in, feel free. For the time being, thanks for being here. Have a lovely weekend. Take care, guys. Bye-bye.